Good morning, everyone. Thank you so much for joining our weekly loan desk room. We're going to be doing another mortgage market update for you all today. And so we've got Joseph here, and he's going to be running through some of the updates that you guys should all be aware of and informed of. And so without further ado, I will let him take over. Joseph, the floor is yours.
Thanks, Hila. Appreciate it. And feel free to drop if you have. I heard you say that you haven't had lunch yet. So,
Oh, no,
yeah,
you're all good.
health and wellness comes first before mortgage market updates. Well, thanks everyone for having me. I think I know most of you on the call. For those who don't know, I lead the mortgage division at Radius, and this week we just wanted to go over basically a couple updates with LoanDesk, the mortgage division at Radius, as well as go over current market rates. And I just wanted to share also, how clients can tap into their equity. So without further ado, let's get started. Uh, Two new partnerships to share with LoanDesk. One is with Rocket Pro TPO, the wholesale arm of Rocket Mortgage. This is a very, very powerful partnership. Basically, what they are building is hard to match from other lenders. And I would say that the biggest differentiators is with Rocket Pro is they do fully validated pre-approvals, and this really gives us both as loan officers and as agents confidence when we submit that offer and include that pre-approval letter. I've had so many listing agents, call. Actually, I'm always surprised at how many listing agents don't call, but many do call, and they'll vet the financing. And I just love it when the deal goes to Rocket and I have a validated pre-approval. I just absolutely love it when I get that call, because I share with the agent, this is not just a pre-approval, this is a validated pre-approval. So what is the difference between a validated pre-approval and just a normal regular pre-approval? Well, I would say basically there's like three types of pre-qualification and pre-approvals. And Kerwin, I'm gonna just, if you don't mind, I heard you say you're going through the pre-approval process, so I figured this is just a good opportunity for me to run through. So I don't have this like in a slide. So if if you guys want to take notes, or ask questions, feel free to make it more informal. But there's three types of pre-qualification for a client before they go into contract. The first one, and different loan officers will have different lingo, but I would say that this is just the way that I think of it, and you guys can either agree or make your own kind of status based on the syntax. First one is just pre-qualified. What that means is essentially the loan officer had a conversation with the client. Hey, I work at such and such company. I make 100K a year. I've got 50K in the bank for a down payment, and my credit score is 698. Okay, cool. Boom, boom, boom. Pre-qualified, and you'll see a lot of pre-qualification letters go out just off inputs that are not validated. So the consumer basically just put all those things into a form field, and then it spits out a pre-qualification. And in my opinion, those are the most dangerous pre-approval or pre-qualifications, because there's sometimes the consumer and the borrower, they're not really quite aware of like things. So they say, oh, I make 100K. They didn't add that they are 1099, or they're recently moved into a commission role as opposed to being W2, or there's all kinds of things that may impact that 100K. Maybe they're self-employed and they're just talking about their revenue, but their actually net income is 20K. Same thing with the credit score. Borrowers today actually have a better sense of their credit score than really ever before, at least with for as long as I've been doing this. So I don't see like huge variances anymore. It used to be like, someone says, oh, I have a 670, and be like 540. I'm like, okay, you were not even close. But now almost every credit card company will include it. Credit Karma made a whole business out of enabling consumers to check their credit for free. But those scores are not the same as the mortgage credit scores. So the scoring system is actually slightly different. And so I always have to educate borrowers, like it's usually when the score is lower, they're usually pleasantly surprised when it's higher, but when it's lower, I have to say, like, look, this is the difference. This is a mortgage score. And borrowers, when they have a mortgage score, all inquiries count as one inquiry in a window of shopping. So they can go out and pull their credit many, many times, and they'll be the same score with all the different lenders. Okay, so back to pre-qualified, have a conversation. Then we have like an automated pre-approval, or so you have basically this. So there's two types of pre-approvals. You have an automated pre-approval and kind of like a sales-driven run pre-approval. So an automated pre-approval is um, you're running credit, or at least doing a soft check. You're still going off the inputs on the income and the assets, and then you're running the automated underwriting system. So for Fannie Mae and Freddie Mac, like this is DU, Desktop Underwriter. For Freddie Mac, it's called LP, Loan Prospector. So and now with sophistication, you actually can run both at the same time. That was a change like 3 or 4 years ago. That was pretty big for the industry. So, anyways, you run these automated underwriting. You're like, okay, I'm getting the approval. Here's what the conditions are. Bing, 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 and you're approved, pre-approved. This is how when you see an advertisement from like an online mortgage company, they're like, we do a pre-approval in 3 minutes or 5 minutes or whatever, 1 second. This is how they're doing it because there's no human involved. It's the inputs from the consumer, soft credit check in the background, or a hard credit pull, run it through AUS, and whatever AUS automated underwriting system spits out, that's what you get. So that would be kind of like an automated pre-approval. Then you have kind of like a sales run pre-approval process. So basically take all of those, the automated pre-approval, and now you put a loan officer whose job is to get mortgages closed, and he gets compensated at the completion of the loan on a commission basis. So they're incentivized. So their job is to get the loan through the door. Their job isn't really necessarily to protect the company. They're not underwriters. So they might look at documents and they might look and say, okay, you said you make 100K. Well, let's see a pay stub. Let's see your 2023 W-2. Now that's a pretty good pre-approval because a good loan officer, one that's been doing it for 5-6 years, can actually be better than some underwriters at knowing how to calculate. But most loan officers, their role is to earn trust, present options, market themselves. It's not necessarily to go through the paperwork, with precision. So we have pre-qualification, we have pre-approval, and then what's a validated pre-approval? A validated pre-approval is one step further. So you run AUS, the loan officer collects the documents, income, assets, and credit, because qualifying for a mortgage is actually quite simple. And then they send that loan to the actual underwriter. The underwriter's job is really to protect the company, to ensure that all the loans that are originated in that fund meet the investor guidelines. So most people think the underwriter's job is to make sure that the borrower repays their mortgage. That's not the underwriter's job. The underwriter's job is to take all the data from the consumer and match it up with investor guidelines. Now, the three largest investors, and if you've been on these calls before, you should already know this: Fannie Mae, Freddie Mac, Ginnie Mae. These are government-sponsored enterprises, and in the case of Ginnie Mae, it's actually a government entity. They buy, I think it's close to 90% of all the mortgages in the United States. So basically what the underwriter is doing is just getting this to match. And I have to explain this sometimes to borrowers because they're confused, that they think that this underwriter is like looking at their situation and thinking, oh, well, are they going to repay their mortgage or not? That's not their job. Because under Fannie Mae guidelines, a 620 credit score with a 3% down mortgage can 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 be qualified under Fannie Mae. Well, if that was my own money, I wouldn't feel very comfortable lending it out to a 620 borrower at 3% down. Whereas you can have a situation where it's a self-employed applicant and they have a 800 credit score and they're putting 20% down, but maybe there's something wrong with their tax returns and it doesn't match the investor guidelines. Now, we have alternative underwriting programs, but under Fannie Mae, Freddie Mac, they have pretty crystal clear guidelines on how to calculate income. So in that case, that borrower may not qualify for that Fannie Mae loan where the 620 borrower with only 3% down does. Now, if it was your own money at stake, let's say it's a $100,000 loan, who would you rather lend that money to? I personally, if it was my own money at stake, I would rather lend it to the 800 credit score, putting 20% down, because basically you're protected by if the market shifts and the home values decrease, less chance of a foreclosure. Also, someone who has a 620 credit score probably has derogatory marks on their credit. They probably have a history of not making payments on time. It's possible they don't make their mortgage on time. So there's all uh, these things that you would think, basically are going to determine who that the underwriter is saying it's not a risk profile. It's purely a matching of data with investor guidelines. So the validated pre-approval is that loan officer provides all those documents and the credit report, the income, the asset, and they actually underwrite the loan just as if they were already in contract, assuming the purchase price is 800,000 with $200,000 down or whatever it might be. They underwrite the loan. So that's a huge advantage then for the client, because they can go out and negotiate a 21-day close of escrow. The loan's already underwritten. All that's needed then is the third-party docs. You got to have the title paperwork. The homeowner's insurance needs to be established, and most likely you'll need an appraisal. Those, in some cases, depending on the down payment, the appraisal could be waived. So you're just waiting on those third-party time frames. So that was a big reason why we chose to work with Rocket Mortgage. No other lending partner that we were currently set up with offered this validated pre-approval process. And so I'm really excited to roll this out to any agent that wants to take advantage of it, because it's a big time negotiation advantage, in my opinion, because the borrower has already been approved by the actual decision maker. This isn't the sales run process. Another partnership that I wanted to announce is we're set up with Spring EQ, and it's under their Express program. Spring EQ is one of the largest home equity line of credit partners. So they do HELOCs, they do HE loans, and we'll get into that in a little bit. And they also do home equity loans in Texas. Many banks, lenders, they don't do home equity loans in Texas because there's some unique Texas rules around accessing equity in your home, but they will allow it. They will also allow home equity loans on investment properties. Many banks, many lenders do not allow home equity loans on investment properties. So if you have clients that are looking to take out 100K to put an ADU, or maybe want to tap into their equity for the new down payment, I'll run through a quick deal scenario that I'm actually going through right now. I have a client, they're buying a $1.5 million home, and they have they have the 300K for a 20% down. So we can do it as a jumbo mortgage, $1.2 million mortgage. Where they're living, the the conforming loan limit is 977,000. And so because their credit score isn't terrific, it's 710 is their credit. The rate is a lot lower on 977 loan amount versus 1.2 million. So what I presented to them is you could do the loan at the 1.2 jumbo, and here's what the rate would be, or you could tap into they currently own their primary, and they're going to convert their existing primary into an investment property. They could tap into their existing primary, take out a home equity loan, and their blended interest rate is actually going to be much lower than the jumbo loan. So basically, they put the money into their bank from their existing primary. And once we ran the numbers, they're like, oh my goodness, I'm saving like $300 a month by going that route. And at the end of the day, it's still $1.2 million is what they will owe. And of course, they can try to go after their higher mortgage interest rate, if they have disposable income. All right, so enough on that slide. Okay, today's rates. So I mentioned in the last call, Freddie Mac, and let me just put it in the chat here where the website is, because I think this is if the more you want to focus on mortgage, I think this is one to bookmark. So I just shared in the chat the website where this comes from. So you can see here, as of 2/8, the average 30-year fixed rate for Freddie Mac loans was conventional conforming loans. So It's like kind of like, again, going back to the investors, is 6.64% for 15 years, 5.9. You can see where it is on that 52-week range. So rates are much lower than just a year ago, or really since like November is I think when they kind of peaked. So that's a good news for buyers. Now affordability is still very much challenged, but um, that's where we're at as far as today's rates. I just shared the link where you can track this yourself. Now, the best way to, and I mentioned this in the last call, the best way to track interest rates, let's see if somebody was paying attention. Joel, what ticker, like if you were to look at a stock ticker, what stock ticker would be the best ticker to look at if you're going to track interest rates, mortgage interest rates? Oh, anybody. Okay, anybody. What's the best ticker if you're going to track what's happening on a day-to-day basis with mortgage interest rates? I mentioned this on the last call. All right, put it in the chat if you don't want to talk. Yes. See, this is where
TNX.
I'm glad then we're going over stuff again.
TNX.
On your iPhone, I would consider adding this one to your stock list, because you can see if you go to the TNX ticker, and if you want, I can put this on the like Yahoo Finance, but I think maybe I have too many browsers open because it's my computer's not working super fast. All right, let's go to Yahoo Finance. And it looks like it was a bloodbath for the stock market today. All right, so I just put in the ticker. So you can see today that the 10-year treasury yields went up by 3.45%. So, I mean, everyone talks about, oh, interest rates going up is a terrible thing, but, also interest rates going up will benefit savers. People who just have money in the bank, like this is kind of a good thing, or, put money in bonds, this is a good thing for them, because today you can buy a 10-year bond at 4.3160%. Yesterday, it was lower. Yesterday, it was 4.16%. So it's kind of like the stock market, like the price of bonds basically change on a daily basis. And the Freddie Mac pricing of the mortgages will depend on the 10-year treasury yield. Now, why do they use a 10-year treasury yield? It's because people don't hold their mortgages for 30 years. Like it might be a 30-year fixed mortgage, but the average length of time of like home ownership is closer to like 9 years, and people also end up refinancing their mortgage. So that's why they use the 10-year treasury yield to make 30-year fixed rates. So as the 10-year treasury yield goes up, so will the Freddie Mac pricing what they will pay for the loan in the secondary market. And so you can see here this week, just in the first 2 days, the 10-year yield has gone up a lot. So remember what I talked about last week, how the national news media is always 1 week behind. So this week, the national news media might be talking about, oh, rates are going down, or maybe on like Friday or this comes out on Thursday. So maybe Thursday and Friday, they said, oh, rates have gone down. Well, guess what? Assuming like rates stay the same or they go up even more, this Thursday, the national news media was like, rates are actually rising now. And you can just follow this with basically that 10-year treasury yield. So here's where LoanDesk is at. So conventional, we're at 6.375 with the APR. In this is assuming good credit borrower. FHA is 5.875. The reason why the APR is higher on FHA is because you have to include the 1.75% mortgage insurance. So if you ever see a FHA rate and their APR being super close to the rate, then that advertiser is doing something wrong and they're not advertising it to the full disclosure, because under advertising guidelines, under truth in lending guidelines, you have to include the 1.75 mortgage insurance premium. And then VA, whoops, I forgot to update this, so I just put the same. So disregard the VA loan. All right, last thing I want to cover here is how to tap into your equity. So there's 4 ways to tap into equity. So all of you have helped people buy homes, and I imagine if you were to reach out to them, and they've probably done well, because home prices have only really continued to go up even in this high rate environment. And if they bought a while back, then I'm sure they're sitting on quite a bit of equity. So like, to me, like, being knowledgeable about mortgage, where this I feel like can help your real estate business, is knowing like these little things, because people are always thinking about like the financial engineering. Like I just mentioned, I talked about the client who wants to upgrade their home, and I mentioned, hey, tap into your equity to get the cash for the down payment. All right, so there's 4 ways to tap into your equity. Number 1 is a cash out refinance. So let's say you have a home that's $500,000. You have an existing mortgage on it that's, let's just say $300,000, and you want to take out $75,000 in equity. Well, you get a new mortgage for $375,000, and it replaces your existing mortgage of $300,000, and that lien is paid off. Now, the downside of a cash out refinance is that the rate might be higher than the rate that they currently have on that mortgage. So that same example, that $300,000 loan, maybe that has a 3% rate. Today's rates on a cash out, maybe 6.75 on a cash out. So you don't really want to do that, because now you're replacing that lower rate mortgage with a higher rate mortgage. That's why basically people aren't doing cash out refinances anymore, because the majority of the population who has a mortgage, I forget the statistic, but it's like super, super high, have a rate below 5. And then there's a very high percentage who have a rate below 4. And then there's even a percentage that has a rate below 3. So it's almost like we created this lock-in effect. Okay, so what can you do if they don't want to touch their first mortgage because they got that low rate? Well, you could do a second mortgage. And what a second mortgage is it just sits on top of that first mortgage. So you have take that same example. So let's say you got a $500,000 home value. They have your client has a $300,000 mortgage. And let's say they want to tap into $100,000 to do a kitchen remodel. Okay. Rather than doing a cash out refi and replacing the first, they just take out one second mortgage for 100,000. So they have a first mortgage of 300,000, they have a second mortgage of 100,000. And there's 2 products that are predominantly used for a cash second mortgage. The first one is a home equity line of credit. A home equity line of credit is like a credit card attached to your home. So you can establish a home equity line of credit without ever even having to pull any of the debt out. So you can have a 0 balance home equity line of credit, just like you could have a credit card potentially that you don't even use. It just remains a 0 balance. If you want to use it, you got it. So it's kind of like a credit card attached to your home, and it will tell you what your limit is. You could have, like, let's say $100,000 limit on your home equity line, and then when you want to tap into it, you can pay. Let's say you want to take out 50 of the 100K, you can do that. You want to take out 100K out of the 100K, you can do that, and then you start paying interest on the mortgage. A lot of the home equity line of credits are structured as interest only, so it's going to have like the lowest payment, and a lot of the home equity line of credits have a variable rate, and sometimes that rate can be variable on a monthly basis. So one month it's 10%, the next month it's 11%, next month it's 9%. It just varies based on whatever the market is at. And this could be an effective way for somebody to tap into their equity when they don't really know when they need the money. Another second mortgage option is a home equity loan. A home equity loan is just like a first mortgage. It's amortizing. So let's say you want that $100,000 mortgage. So rather than doing a line of credit, you just get a second mortgage of $100,000. Let's say it's amortized over a 20-year fixed period, just like your first mortgage. You have a fixed rate for 20-year fixed, and it could be 8.375%, and that's your rate on that 100K. You just make the payment every single month for the next 20 years. There's no prepayment penalty. You can pay it off faster, which I always encourage people to do, especially if the rate is high. If it's above 7%, better to probably pay that off and than to invest the money, because that's a guaranteed rate of return of basically 8.375% rather than the opportunity cost. So that's in some ways easier to understand because it's just like the first mortgage. We're moving on to the third way to take cash out, how to tap into equity: reverse mortgages. So you have a client who has a lot of equity in their home. They may not have a lot of income. Well, they can use their equity to age in place. So it could be a case where they're actually getting a lump sum payment, or they're getting a monthly payment, and the balance of the mortgage continues to go up and up, while they continue to basically live in the property. So this is great for somebody who wants to age in place. Fourth way to tap into your equity is a home equity investment. And this is kind of a genius financial vehicle that was created just in the last 10 years. Home equity investment is when you basically go into shared co-ownership with an entity. So let's say that we'll take that same $500,000 home value. You have a $300,000 mortgage, and they want to get 100K in equity. So 100K is 1/5 of the total value of the property. So rather than borrowing 100K, they sell a 20% share of their home to an investor. And I can see I'm kind of almost like breaking up here. And so they sell 100K, and so they sell 20% of their home for $100,000. All right. Sorry, I think I was breaking up there, but we've partnered with a couple lenders, or not even lenders. There are a couple more, companies that basically offer this home equity investment. Great tool for when a client has very poor credit. Okay, so we're almost at that 1 o'clock. I think the video is starting to kind of cut in and out. So let's stop here, and thank you guys for joining today's market update. Look forward to talking next week.